Where most people get confused is they think bank reserves are just like money, they're not. They're not. And most people think that the banks themselves actually lend out these bank reserves, and that's what creates new additional loans. And that's a faulty way of thinking. I think it starts by defining and understanding what makes a society wealthy. And for a variety of reasons, I think we've been brainwashed to believe that these green pieces of paper or whatever electronic digits we have in our checking account, that's what makes us wealthy. It's not it. It's not it. What makes a society wealthy is the quantity of goods and services it can produce efficiently, and hopefully more efficiently, meaning cheaper, over time. When we look at what the Fed's doing in distorting, is the best word to use, markets, distorting the economy, misallocating resources, creating malinvestment in the economy, you have to ask yourself over the long term, does this create a foundation where our economy will produce fewer goods and services or more goods and services? And when you have these distortions, when you misallocate scarce resources with alternative uses, the conclusion you have to come to is that our economy will create fewer or create a lot less stuff moving forward than unfortunately it did in the past. What does that mean? That our society will be poorer as a result. I don't care how much UBI we have. I don't care how much MMT. I don't care how much the Fed can prop up the stock market. It doesn't matter. And again, no certainties, only probabilities. But in my opinion, the probability is highest that we're going to be producing less stuff in the future. Therefore, as a society, unfortunately, we will be poorer. The Fed expands their balance sheet by buying assets from what they call primary dealer banks mostly. And these assets would be treasuries, mortgage-backed securities. And how do they buy them? They create new bank reserves, just literally out of thin air. They say, okay, JP Morgan, we're going to buy $1 billion worth of treasuries from you. And JP Morgan has an account with the Fed. So the Fed just credits their account $1 billion worth of new bank reserves. And that's kind of like an asset swap. So those treasuries go onto the asset side of the Fed's balance sheet. And that is replaced by $1 billion worth of bank reserves, which now is a liability of the Fed, an asset of JP Morgan. Okay, so really from JP Morgan's standpoint, the only thing that changes is they're just trading treasuries, in this case, for bank reserves. Where most people get confused is they think bank reserves are just like money, they're not. They're not. And most people think that the banks themselves actually lend out these bank reserves, and that's what creates new additional loans. And that's a faulty way of thinking, and the devil's in the details there. Because when if you think that the banks lend out reserves, you see them as intermediaries, and they're not. They create the money supply in the real economy. So the only thing those bank reserves do is back up new loans. So if they have $1 in bank reserves, then they can create, let's say, $10 worth of loans in the real economy. And that means M2 money supply would increase by $10. Another way of saying that, there'd be an additional $10 in the real economy chasing the same amount of goods and services. But the bank reserves never increase or decrease. It always stays the same. The only thing that can decrease the bank reserves or increase them is when the Fed buys or sells assets. So my point is that the commercial banking system in that example had to take an action. They had to create a loan. They had to do something. If the Fed just comes in and creates bank reserves, it's just really an asset swap. It doesn't, the Fed could take their balance sheet to 20 trillion and a quadrillion, and it really wouldn't matter. But in practice, it does, because it expands the balance sheet capacity for those banks and therefore they can go out and they can create additional loans. The banks are now, since the GFC, they're looking around the real economy, they're looking at the risk reward and saying, we don't want anything to do with this. We don't want to create more loans. We don't want to create more productive loans for entrepreneurs to go out there and create more goods and services and make the society richer, because we see too much downside, not enough upside, because the Fed drops rates down to zero.
Right.
So the banks have a hard time lending out money at a sufficient hurdle rate, right? So what they can do, they say, okay, well, we've got to make money somehow. So if we don't want to lend out to the real economy for productive lending because we don't like the risk reward, okay, why don't we just maybe give it to these hedge funds or create loans, additional loans for hedge funds or financial institutions, and they can come in and they can drive up stock prices, or they can create some sort of derivatives, do interest rate swaps, or we can go into the repo market and we can kind of, again, financial engineering to try to get the same type of return on our investment with a lot less risk, because we know the Fed has our back, meaning that whether it's real or just psychological, they think that the Fed won't allow the stock market to go down more than, let's say, 15%. So they can just lever up, go into these risk assets like stocks. They know that their downside is capped because the Fed has their back. But if the Fed continues to print money, or create more bank reserves, most likely retail will see that, pile into their 401k. And we didn't even talk about passive funds. That's a big, big deal. Those passive funds are indiscriminate buyers. They buy, drive stock prices higher. So the point is, the risk reward for the banks is superior, although it's very perverse. It's superior by lending it to these financial institutions instead of out into the real economy. That's why when the Fed increases their increases their balance sheet, most of the time you see risk assets go up.